Isaac Newton calculated the orbit of every planet in the solar system. He invented calculus. He defined the laws of motion that still govern how we build bridges, launch rockets, and engineer skyscrapers. In the spring of 1720, he sat inside his London study at the Royal Mint, where he served as master, and made what looked like a brilliant financial decision. He sold his shares in the South Sea Company for a clean profit of around $7,000. He did the math. He saw the price rising beyond reason. He cashed out. Then he bought back in at double the price. And he kept buying. By the end of that year, the man who mapped the heavens had lost somewhere between $12,000 and $20,000 of his personal fortune. In today's money, that loss translates to roughly $20 million. The same brain that decoded gravity failed to decode the oldest trick in finance, a rigged game dressed up as an opportunity. Most people hear this story and walk away with a simple lesson about greed. Smart man gets greedy. Smart man loses money. End of story. That reading is wrong, and it is wrong on purpose. The South Sea Bubble of 1720 was not a wave of mass stupidity. It was a machine, built by insiders, funded by bribes, protected by Parliament, designed to convert Britain's crushing national debt into private stock, inflate that stock to absurd heights, and leave ordinary investors holding the wreckage while directors and politicians walked away with cash. Newton was not fooled by his own greed. He was fed into a system of extraction engineered at every level, from the boardroom of the South Sea Company to the floor of the House of Commons. The stock did not rise because of market confidence. It rose because insiders made it rise. And it collapsed because the math behind the scheme was never designed to last. It was designed to transfer wealth. Debt did not make the South Sea Company dangerous. It made the company a weapon aimed at every holder of government annuities and every retail buyer who trusted the price on a printed stock sheet called the course of the exchange. The company's directors controlled the flow of information. They controlled the supply of shares. They controlled the terms of purchase. They sat at every bottleneck between Britain's treasury and the public savings, and they extracted from every one of those bottleneck positions. Welcome to Noob Historian. We follow the money, trace the power, and expose the history they never taught you in school. This story matters to you right now because the machinery the South Sea Company built in 1720 is the same machinery that wrecked the global economy in 2008. Toxic debt repackaged into attractive financial products. Insider knowledge shielded from public view. Regulators who were supposed to protect ordinary investors, but instead served the interests of the people selling them worthless paper. The names change. The suits change. The mechanism stays identical. And if you own a pension, a 401k, a mortgage, or a savings account, you are sitting inside a version of this machine today. To understand what the South Sea Company built, you need to understand the crisis it was built to exploit. By 1711, Britain was drowning. The War of the Spanish Succession had run for 9 years, and the government owed roughly $9 million in short-term debt. This was not ordinary debt. It was a tangle of unfunded obligations, army pay warrants issued by paymasters, lottery tickets, and annuities. Different instruments, different interest rates, different maturity dates, no centralized system to manage any of it. Government debt traded in London's coffee houses, and it traded at deep discounts. A warrant promising $100 might sell for $55 because nobody trusted the government to pay in full or on time. Creditors wanted out. The Treasury needed a way to consolidate, simplify, and push the repayment timeline further into the future. Enter the Sword Blade Bank. Around 1710, the Sword Blade Bank had run a small-scale version of what would become the South Sea Scheme. It offered to exchange unsecured government debt for Sword Blade shares. Before announcing the exchange, the bank secretly bought large quantities of discounted government debt. When the exchange was announced, the price of that debt rose. The Sword Blade insiders pocketed the difference. The Federal Reserve Bank of New York, in its 2013 institutional analysis by researchers James Nairn and David Skee, identified this as what we would now call insider trading. The Sword Blade operation was a prototype. In 1711, 5 of its directors carried the blueprint straight into the founding of the South Sea Company. The company received a royal charter and a nominal monopoly on British trade with South America. The trade monopoly was theater. Britain was at war with Spain, which controlled South America. There was no trade to be had. The 1713 Treaty of Utrecht gave Britain only a limited contract to supply enslaved people to Spanish colonies, and even that generated minimal revenue. The real business of the South Sea Company from its founding was financial engineering, debt conversion. The company absorbed government obligations and issued its own shares in return. Creditors who held messy, illiquid government debt received clean, tradable South Sea stock. The government got a simplified balance sheet and a lower interest rate. And the company got something worth far more than trade profits. It got leverage over the British state. P.G.M. Dixon, in his 1967 study, The Financial Revolution in England, traced this structure through Treasury records and Exchequer ledgers. The company performed additional debt conversions in 1715 and 1719, each time absorbing more government liabilities. Each conversion gave the company more stock to issue, more capital to deploy, and a tighter grip on the flow of money between Parliament and the public. By 1719, the company's directors saw the full scale of the opportunity in front of them. Britain's national debt stood at approximately $50 million. Around $32 million of that sat in long-term irredeemable annuities, paying between 4% and 5% interest. These annuities were expensive for the government and illiquid for their holders. The South Sea directors proposed the largest debt-for-equity conversion in financial history, absorb the remaining $32 million, issue company stock in exchange, and use the annual interest payments from the government as dividends to shareholders. The scheme had one critical feature that turned it from a legitimate financial restructuring into a wealth extraction engine. The higher the company's stock price, the fewer shares it needed to issue to absorb the same amount of debt. If shares traded at $300, the company needed to issue many shares to cover $32 million. If shares traded at $1,000, it needed far fewer. The surplus shares, the gap between what was needed and what was authorized, belonged to the directors. They could sell those surplus shares at inflated prices and pocket the proceeds. This meant the directors had a direct personal financial incentive to push the stock price as high as possible for as long as possible, regardless of whether the price bore any relationship to the company's actual earnings or assets. The South Sea proposal needed Parliament's approval. It was not the only offer on the table. The Bank of England submitted a competing bid to absorb the national debt. A bidding war broke out. The South Sea Company won. It won because it paid. The House of Commons convened a committee of secrecy in early 1721 to investigate what had happened. The committee operated behind closed doors from February to June of that year. Its published reports documented $574,000 in stock option bribes distributed to members of Parliament to secure passage of the South Sea Act. At the center of the bribery network sat Robert Knight, the company's cashier. Knight maintained a ledger known as the Green Book. This book recorded every bribe, every stock allocation, every gift of fictitious shares to officials who had never paid for them. The parliamentary investigation found that the company had falsely inserted or deleted names from its shareholder lists to conceal these transactions. When the committee moved to examine Knight in full, he fled to the continent, taking the Green Book with him. The ledger that named every complicit politician in Britain sailed across the English Channel and vanished from the reach of parliamentary subpoena. Knight's escape was not an accident. Powerful people needed him gone. The Green Book contained names that would have brought down the government. Robert Walpole, the politician who rose to manage the crisis, and who was recognized by Britannica as Britain's first prime minister, later suppressed wider investigations into bribery and corruption to protect the Hanoverian regime and the monarchy itself. The one official who could not escape accountability was John Aislabie, the Chancellor of the Exchequer. Aislabie had championed the South Sea scheme in Parliament. He had received company stock while the bill was still pending. The House of Commons found him guilty of most notorious, dangerous, and infamous corruption, and sent him to the Tower of London, where he sat for close to 5 months. Aislabie was the exception. Most of the architects walked free. The Green Book never returned. This is the part of the story that matters most and gets told the least. The South Sea bubble was not an accident of crowd psychology. It was an engineered outcome. The company needed Parliament to approve its debt conversion scheme. Parliament approved it because company directors paid sitting members of Parliament with stock options worth $574,000. The gatekeepers who were supposed to protect the public had been bought, and the prices recorded in parliamentary archives, held at the British National Archives, and reproduced in Harvard's Baker Library Special Collections. With parliamentary approval secured in April 1720, the company launched the inflation phase. This was not a passive process. The directors did not sit back and let the market decide the stock price. They built a pressure system designed to force the price upward through 4 successive rounds of public stock sales, each one structured to pull more money from investors on looser terms. This was not a passive process. The directors did not sit back and let the market decide the stock price. They built a pressure system designed to force the price upward through 4 successive rounds of public stock sales, each one structured to pull more money from investors on looser terms. The first money subscription opened in April 1720, offering $2 million new stock at $300 per share. Buyers needed only 20% down, with the balance due in installments every 2 months. The terms were generous by the standards of the era. The subscription sold out. Buyers needed only 20% down, with the balance due in installments every 2 months. The terms were generous by the standards of the era. The subscription sold out. The second money subscription followed weeks later, also in April, with terms that let participants borrow up to $3,000 each. More money flowed in. More money flowed in. The third money subscription loosened the terms further. Down payment dropped to 10%. Installments stretched across 4 years. The second payment was not due for a full year. The company needed these easier terms because it needed ever larger volumes of incoming cash. Stock sale proceeds were not building a war chest or funding trade operations. The cash went to three destinations: dividend payments to existing shareholders, bribes to government officials, and purchases of the company's own stock to support the price. The company was buying its own shares on the open market to create the appearance of demand. Down payment dropped to 10%, installments stretched across 4 years. The second payment was not due for a full year. The company needed these easier terms because it needed ever larger volumes of incoming cash. Stock sale proceeds were not building a war chest or funding trade operations. The cash went to three destinations: dividend payments to existing shareholders, bribes to government officials, and purchases of the company's own stock to support the price. The company was buying its own shares on the open market to create the appearance of demand. The fourth money subscription launched in August 1720 and carried the most extraordinary promise in 18th century finance. The company pledged a 30% dividend at year's end and a 50% annual dividend for the next 10 years. The Federal Reserve Bank of New York's analysis by Narin and Skye flags this moment as the breaking point. The market did not believe the promise. The numbers were too large. The company's actual revenue from government interest payments and its negligible trade income could never support dividends of that scale. The company pledged a 30% dividend at year's end and a 50% annual dividend for the next 10 years. The Federal Reserve Bank of New York's analysis by Narin and Skye flags this moment as the breaking point. The market did not believe the promise. The numbers were too large. The company's actual revenue from government interest payments and its negligible trade income could never support dividends of that scale. Between January and August 1720, South Sea stock rose from $128 to over $1,000, an 800% increase in 8 months. Dixon traced this trajectory through the course of the exchange, the official London price list published by John Castaigne, and through Freak's prices of stocks. The rise was not organic. It was manufactured by 4 rounds of subscription sales that created the appearance of limitless demand, by company purchases of its own stock, and by a constant stream of rumors about South Sea trading profits that never materialized. An 800% increase in 8 months. Dixon traced this trajectory through the course of the exchange, the official London price list published by John Castaigne, and through Freak's prices of stocks. The rise was not organic. It was manufactured by 4 rounds of subscription sales that created the appearance of limitless demand, by company purchases of its own stock, and by a constant stream of rumors about South Sea trading profits that never materialized. During this same summer, the Bubble Act of 1720 passed through Parliament. The act banned rival joint stock companies from issuing shares without a royal charter. The standard interpretation calls this an attempt to regulate speculation. The operational reality was different. The South Sea Company needed to eliminate competition for investor capital. Nearly 200 new ventures had launched that year, all competing for the same pool of money. The Bubble Act shut them down. But it did so clumsily. When rival stock prices collapsed under the ban, leveraged investors were forced to sell whatever they could to cover their losses. That meant selling South Sea stock. The company's own weapon created selling pressure it could not absorb. The act banned rival joint stock companies from issuing shares without a royal charter. The standard interpretation calls this an attempt to regulate speculation. The operational reality was different. The South Sea Company needed to eliminate competition for investor capital. Nearly 200 new ventures had launched that year, all competing for the same pool of money. The Bubble Act shut them down. But it did so clumsily. When rival stock prices collapsed under the ban, leveraged investors were forced to sell whatever they could to cover their losses. That meant selling South Sea stock. The company's own weapon created selling pressure it could not absorb. By September 1720, the fourth subscription's dividend promise had failed to convince the market. The Bubble Act had triggered forced selling, and the concurrent collapse of John Law's Mississippi Company in France had drained liquidity from London. The Sword Blade Bank, the South Sea Company's own financial arm, faced a run. Panicked depositors demanded gold coin in exchange for banknotes. The Sword Blade Bank closed its doors on September 24, 1720. It could not pay. The Bubble Act had triggered forced selling, and the concurrent collapse of John Law's Mississippi Company in France had drained liquidity from London. The Sword Blade Bank, the South Sea Company's own financial arm, faced a run. Panicked depositors demanded gold coin in exchange for banknotes. The Sword Blade Bank closed its doors on September 24, 1720. It could not pay. The contagion spread. Other banks failed. South Sea stock, which had touched $1,000 in August, fell to $124 by December, an 88% decline from the peak. Dixon's records placed the final price at almost exactly where it had started the year, 12 months and billions in destroyed wealth later. South Sea stock, which had touched $1,000 in August, fell to $124 by December, an 88% decline from the peak. Dixon's records placed the final price at almost exactly where it had started the year, 12 months and billions in destroyed wealth later. Isaac Newton's role in this story is the part people remember and the part most people get wrong. The popular version goes like this. Newton bought early, sold for a profit, got greedy, bought back in at the top, and lost everything. A morality tale about hubris. Andrew Odlyzko's 2019 peer-reviewed paper in Notes and Records of the Royal Society's Journal dismantles this narrative with Bank of England ledgers, the Thomas Hall estate account book from King's College, Cambridge, and the course of the exchange price records. Newton's financial life was more sophisticated than the folktale suggests. At the start of 1720, his portfolio stood at approximately $32,000. He held a diversified mix of government securities, Bank of England stock, and South Sea shares. In April and May 1720, Newton sold his South Sea holdings for a clean profit. Up to this point, his behavior was rational and well-timed. What happened next is where the standard story breaks down. Newton did not simply get greedy. He re-entered the market at approximately double the price he had sold at. More significantly, Odlyzko's research shows that Newton converted nearly all of his remaining government securities into South Sea stock near the peak of the bubble. He moved from a diversified portfolio into a concentrated bet on a single asset at the worst moment in the asset's history. By mid-1721, Newton's portfolio had dropped to roughly $20,000. Against a strategy of doing nothing, of simply holding his original portfolio unchanged, why did the man, who understood celestial mechanics better than any human alive, fail to see a financial collapse forming in front of him? Odlyzko's analysis points to groupthink. Newton was not operating in isolation. He was surrounded by wealthy, educated, well-connected people who were all buying. His social circle, his colleagues at the Royal Society, his contacts at the Mint, and the broader London establishment were all participants in the bubble. When everyone around you is buying, and when every price signal in the market points upward, the force required to stand apart is not intellectual, it is psychological. Newton had the intellectual capacity to see the flaw in the South Sea scheme. What he lacked was the social independence to act on that analysis when his entire world was moving in the opposite direction. This is the lesson the Newton story holds, and it is not about greed. It is about infrastructure. The South Sea Company built an information environment that made buying feel rational and selling feel reckless. The company controlled the narrative. It controlled the subscription terms. It controlled when new shares entered the market. It paid the press. It bribed Parliament. Every signal Newton received, from the stock price on the course of the exchange to the dinner conversation at the homes of his peers, was tainted by the company's influence. Newton was not beaten by his emotions. He was beaten by a system that had been designed at every point of contact between the company and the public to produce the behavior the company needed, buying and more buying, and buying again at higher prices. As Odlyzko observes, future generations will likely also laugh at most of the pre-2008 pronouncements about market stability because the financial instruments investors faced were much simpler than the ones we are tempted with. Newton's South Sea shares were straightforward equity. Modern investors faced derivatives stacked on derivatives, credit default swaps, collateralized debt obligations, and algorithmic trading strategies that operate in milliseconds. If Newton could be captured by a scheme this simple, the vulnerability of modern investors is not smaller. It is larger. The South Sea bubble did not end in 1720. Its architecture became a template. Strip the scheme down to its components. Toxic government debt gets repackaged into an attractive financial product. Insiders understand the fragility of the product before the public does. Political actors who are supposed to regulate the system are compromised. The product's value depends on prices rising forever. When prices stop rising, losses cascade outward to the people who bought last and understood least. Now apply those components to 2008. In the years before the financial crisis, subprime mortgages were bundled into mortgage-backed securities. Those securities were sliced into tranches and repackaged into collateralized debt obligations, CDOs. Some CDOs were assembled from the riskiest tranches of other CDOs, creating instruments called CDO squareds. Ratings agencies stamped AAA grades on these products, signaling to pension funds, insurance companies, and ordinary investors that they were safe. The safety rating depended on a single assumption, that housing prices would keep rising. In 1720, the South Sea Company repackaged illiquid government annuities into equity shares whose value depended on the insider dynamics mirror each other. South Sea directors sold personal holdings while encouraging the public to buy. Lehman Brothers executives reduced their exposure to mortgage-backed securities while the firm's salespeople pushed those same products onto clients. Goldman Sachs built the Abacus CDO, designed in collaboration with a hedge fund manager who was betting against it, and sold it to investors without disclosing that the instrument had been constructed to fail. The political corruption parallels run equally deep. In 1720, South Sea directors distributed $574,000 in stock option bribes to members of Parliament. In the years before 2008, the financial industry spent billions on lobbying and campaign contributions. The revolving door between Wall Street and Washington ensured that regulators understood the industry from the inside, and that understanding became a form of capture. The people writing the rules had built their careers at the firms those rules were supposed to constrain. The contagion patterns match. The South Sea bubble did not stay in London. It interacted with John Law's Mississippi Company collapse in France, creating the first documented international financial contagion. The 2008 crisis did not stay in the American housing market. It cascaded through interconnected derivatives markets to every major economy on Earth. And the political aftermath follows the same structural logic. The South Sea crash produced a new concentration of executive power. Robert Walpole navigated the crisis, suppressed investigations that would have damaged the crown, and emerged as the first figure to hold what we now call the office of Prime Minister. The 2008 crash cemented the Federal Reserve's role as lender of last resort to the entire global financial system. In both cases, crisis produced a new center of authority, and that authority was built on the wreckage of the previous system's failure. The distance between 1720 and 2008 is 288 years. The mechanism did not evolve, it scaled. Robert Knight's Green Book never came back to Britain. The ledger that named every bribed politician, every fictitious shareholder, every secret allocation of company stock crossed the channel and disappeared. Its absence protected the powerful. Walpole's government chose stability over accountability. The monarchy survived. The Hanoverian succession continued, and the lesson absorbed by every financial operator who followed was clear. If you are big enough and connected enough, accountability is optional. The South Sea Company itself survived the crash. It continued to exist as an entity until 1853, well over a century after the bubble collapsed. Its trading operations never amounted to anything of substance. The company's primary function for its remaining decades was managing the converted government debt it still held. The shell lived on, long after the scheme inside it had been exposed. Newton lived until 1727. He never spoke publicly about his losses. The quote attributed to him, that he could calculate the motions of heavenly bodies, but not the madness of men, appears in historical accounts, but lacks definitive sourcing in Newton's own hand. Odlyzko's research treats the quote as unverified tradition. What is verified, through Bank of England ledgers and the Thomas Hall account book, is the scale of his financial ruin. The numbers are in the records. They do not need a quote to tell the story. The Green Book's absence is the final lesson of the South Sea bubble, and it is the lesson that connects 1720 to your life today. In every financial crisis since, there has been a Green Book, a set of records that names the insiders, traces the flow of money, and reveals who knew what and when. In 1929, it was the margin lending records that showed how banks had fueled speculation they knew was unsustainable. In 2008, it was the internal emails at ratings agencies, where analysts described the products they were certifying as safe with language that indicated they knew the ratings were wrong. And in every case, the Green Book either vanishes, gets redacted, or arrives too late to produce accountability on the scale the crisis demanded. After 2008, one senior executive from a major bank went to prison. 1. The Financial Crisis Inquiry Commission published its report. The Dodd-Frank Act imposed new regulations, and within a decade, many of those regulations were rolled back. The machinery survived. The gatekeepers returned to their posts. Your pension fund holds instruments that descend in a direct line from the debt-for-equity swap the South Sea Company pioneered in 1720. The principle of repackaging obligations and selling them as safe assets runs through the entire architecture of modern finance. Government bonds, mortgage-backed securities, exchange-traded funds built on layers of derivatives. The complexity has increased by orders of magnitude since Newton's time. The core mechanism has not changed. The South Sea directors understood something about financial systems that most investors still do not understand 3 centuries later. The system does not need you to be stupid. It needs you to be trusting. It needs you to believe the price on the screen, the rating on the product, and the assurance from the regulator. Newton was not stupid. He was trusting. He trusted the information environment that surrounded him, and that environment had been built by people who profited from his trust. Every time you see a financial product marketed as safe, ask who built it. Ask who profits from selling it to you. Ask whether the people selling it are also buying it, or whether they are positioned on the other side of the trade. Ask where the Green Book is. Because there is always a Green Book, and it is always, at the moment it matters most, somewhere you are not allowed to look. The South Sea bubble was not a cautionary tale about human greed. It was an instruction manual for institutional fraud. The company's directors did not stumble into catastrophe. They built it, sold tickets to it, and walked out through the back door. 3 centuries of financial history since 1720 show a single repeating pattern. The losses flow downstream, the profits flow upstream, and the ledger that connects the two disappears. The next bubble is not a matter of if. The infrastructure for it exists right now in the debt obligations your government carries, in the financial products your retirement funds hold, and in the gap between what insiders know and what you are allowed to see. Newton saw the heavens with perfect clarity. He saw the market through a window the South Sea Company had built for him. And through that window, the view was designed to show him one thing only: a reason to buy.